Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today, the guy that needs no introduction, Mr. Michael Becker. Mr. Michael Becker, how are you?
Hey, Paul, doing well. How are you today?
Well, we're doing all right. I kind of feel like Noah. I keep on seeing these animals being pushed together, the giraffes, two giraffes and two zebras and two whatevers. It hasn't stopped raining in Texas for, I don't know, 10, 15, 20 days. It has been unbelievable.
Yeah, I know. Already we've got 3 or 4 paint jobs we can't get done because of the rain. So as soon as it stops, it'll be 100 and won't rain for 3 months. So I guess we better enjoy what's here.
Yeah, it's been a wet May, and now we're into June. So we're looking forward to having some drier days in Texas and more positive things. Michael, just on a big picture of things, what are you seeing these days with the occupancy of your properties, that the SPI portfolio? How's it looking?
Paul, we're jam-packed full, all-time highs, approaching 97% physical. And for Texas, that's real high for Texas, historically probably 3 to 4% above kind of historical norms. And we're starting to collect all this magic money that through the rent relief funds that we thought we would kind of mentally written off. We're probably going to collect, 70 or so percent of that money's kind of flowing as we speak. So that's starting to come in, and things are pretty good. Rental rates are going through the roof. May is probably the highest month in lease trade outs we've seen in 8-9 years. I would imagine probably back to the early part of the 2012, 2013, kind of coming out of the Great Recession. So things are real bullish, much more so than say a year ago. Everything's pretty strong.
So we asked Michael because he has operational intelligence about what's going on with the multifamily business in Texas, and some of the areas of Texas that Michael and his group over at SPI own are Dallas and Fort Worth, Austin, and San Antonio. Now San Antonio, it looks like you guys are going into another market.
Yeah, pretty bullish on San Antonio. I think it's a reasonable time to enter. Kind of we talked about it previously, but it's a pretty similar size market to Austin. And Austin's got 22,000 units under construction, and on San Antonio has about 5,000. So we think that the supply demand balance is much more equilibrium down there, presently speaking.
So we asked Michael about these questions. As you don't know, Michael is a former banker, now has turned into an apartment operator. He's done a great job over at SPI. So we asked Michael the operational questions, but of course we asked JP CONKLIN, our guest, JP CONKLIN, about where the economy is going, where interest rates are going. And so JP is with Pensford, and Pensford are the interest rate people. So if you have a question concerning interest rates and where they're going to, better known as the guy who has the crystal ball, it is JP CONKLIN. So JP, thanks for coming on to the Old Capital Podcast again.
Thanks for having me, and thanks for forgetting that my crystal ball has broken every time I've gotten on with you guys. So I'm sure I will keep that trend going.
That's great. So as you know, JP joins us pretty much on a quarterly basis to kind of give us an insight about what's going on. People have so much money at risk these days. It's important to have some inside information about where we think interest rates are going, not just today, but in the future too. So we turn to JP with some of his great knowledge. And so I'm going to turn it over to Michael. Let's start asking some great questions. Go ahead, Michael.
Yeah, we're going to have an exciting topic tonight. We're going to talk about repos and reverse repos. So I know what everyone's so excited to learn about, but yeah, I didn't even know what the hell a repo was until we were talking about the SOFR transition a few years ago, and all of a sudden SOFR went through the roof in 2019, and started paying attention to what it is. So maybe JP, I don't know if you're going to be the self-proclaimed repo expert or not, but maybe you could talk kind of just real high level. What the hell is the repo market, and what's the hell is the reverse repo market?
Yeah, and just as a disclaimer, I know less about the repo market than I do about interest rates. So this is going to be a real snooze fest. But essentially, a repo is a collateral-backed short-term loan. Most commonly, It is between financial institutions, and it's backed by treasuries. So really the genesis of this was matching up treasuries with cash. So someone might have a short-term need for cash, and they don't want to necessarily sell something in their portfolio. They just need to get by. They don't want to trigger some sort of tax implication. And so they would be paired up with somebody who maybe just had an abundance of treasuries in this example, and say, we can make a swap here. And we just tend to do it for an overnight purpose, go run your payroll or whatever. And the repo market is an enormous market. And so a lot of funding goes on behind the scenes that most people never know about because it happens so fast. But that's been out there for a long time. And then SOFR was really the repo that really came to the forefront. They started pushing that probably back in around 2015, and it really gained steam in around 2018. And we all know it's meant to ultimately replace LIBOR, but it's nothing but a repo rate. And it's just a short-term rate, a loan backed by treasuries as the collateral. So it's supposed to be almost risk-free. And that's what the Fed has been pushing for, is we want a market-driven instrument that is risk-free. We can establish a risk-free rate, and then above that is any sort of borrowing spread that a borrower might pay.
Right. And so this was the big push from the Fed of starting, 5 or 6 years ago, was to get away from LIBOR, because LIBOR could be manipulated by 20 banks into SOFR. And then, I know looking back almost 2 years ago, there was a week or two where SOFR spiked, dramatically overnight. And then all of a sudden the Fed came in and stopped that. I don't know if you have any comments around that incident a few years ago.
It made me wonder aloud more than once why we were bothering to switch out an index that could be manipulated by 20 banks for an index that could be manipulated by one bank, the central bank.
Right.
It seemed to defeat the purpose. If we want a market-driven instrument, which I think is totally legitimate to want that, then that comes with some downside, and that includes volatility. And yet the minute it misbehaved, they immediately jumped in and calmed everything down by flooding it with billions of dollars overnight. So
what caused that spike in 2019? Because right now we're kind of seeing the opposite of that. But what caused that spike in late 2019?
Lack of cash. Everyone started holding their cash, hoarding it, and just refused to lend it out at almost any rate. And so even though interest rates were, 1% at that time, SOFR spiked over 5%, with even some like daily transactions actually being north of 10%, because somebody who was desperate for cash was willing to pay 10%. Just give me that cash. I got to get through the next 24, 48 hours to, pay something. And so they were willing to pay an exorbitant rate for a short amount of time. So the Fed jumped in and said, we need to flood the market with cash. They did that, and everything settled down, and it's been bumping along zero for the last 18 months.
And then so here we are, and like Paul said, June of 2021, and I've been reading some articles here lately about the reverse repo market and how it's going to potentially put the front end of the interest rate curve negative. So what the hell is a reverse repo market?
So that was largely created post-financial crisis because the central bank wanted its financial institutions, the banks, the money market funds, to have a place to put this excess cash, right? Like they knew that the Fed knew that it would be flooding the market with so much money that there would actually be too much cash and not enough places to, put that out in the repo market. So they said, you know what, we will become our own repo market, and we will basically take all comers. And they put a cap on it of 30 billion per counterparty, so you couldn't take advantage of it too much. But it was really just like a relief valve. So if financial institution ended up having too much cash on hand, and there was no market for them to lend that out, that they could at least just take it to the Fed and say, you take it, give me some treasuries as collateral for short-term nature, and then we'll swap back in a day or two. And so that was really the genesis for it. In mid-March, the outstanding daily volume was zero. Literally zero was being used in the reverse repo program. And since then, the daily volume has spiked to $500 billion a day.
Oh, wow. And so what's causing that? Why is there so much volume presently?
So at the end of March, there was this expiration of this exemption to something called the supplemental leverage ratio. And I just threw a whole bunch of stuff at people that is super exciting. I know they're going to go dig into, but I'll give you the high level overview anyway. It essentially says, we know, as the Fed, we know that by flooding the market with cash, and by buying up Treasury bonds as part of quantitative easing, we are going to distort the regulatory ratios that banks have to adhere to. So we're going to give you an exemption for that. And that exemption expired March 31st. And I can remember doing a podcast saying, I'm sure that they're just going to extend it. There's no reason not to extend it. Just kick this can down the road another 6 months. And they did not extend it and caught me off guard. And I was mostly at the time focused on the thought that the banks might have to sell treasuries in order to maintain this ratio. And if they sell treasuries, that puts upward pressure on interest rates. And that's what I was mostly focused on, not really realizing that we might end up in a situation like we are now where the reverse repo market has exploded and there's actually like too much cash chasing too few treasuries. So it's just become a very distorted market. And now you're seeing on the front end of the curve, particularly, interest rates dive towards zero. That's why you keep hearing about LIBOR setting a new low every single week. It's just continually being compressed towards zero. I mean, even 4-week T-bills have been yielding 0% for the last 2 months. I think 8-week T-bills are down to like half of 1 basis point. So almost zero. And so there is this threat right now that the front end will go negative at some point here in the near future. And overnight repo rates, not through the reverse repo program, just general overnight repo rates are already negative 1 basis point.
And so what happens if the front end of the curve go negative? Is that something you think the Fed will actually let happen in reality?
I don't think so. I think they don't want to give the perception that they've lost control of that part of the curve. Like that's the part of the curve that they're supposed to be able to control. And I think that they will take steps if necessary to avoid that happening. If the front end goes negative, it's because Jay Powell wants it to go negative. I think that's his mentality. So the Fed will take steps if needed to intervene. I don't think that they view this as a huge problem in the grand scheme of things. I think it's mostly a problem of optics. Unlike September 2019, too much cash is better than not enough cash.
Yeah. So what can they do actually if we do start getting in this pressure? What tools are in the toolbox to solve this problem?
Yeah, so they've got several things they could do. Number one, I think it's the most likely candidate is that they'll just increase the interest that they pay on excess reserves. Basically, banks are required to keep a certain amount of deposits on the balance sheet at the Fed. And then you can have excess reserves there, basically like a cushion. And I think that they could increase the rate that they pay on that. And that would divert funds away from repo over to this excess interest. And because it would just make sense for a Treasury to switch their money over there and get paid a little bit more interest. I think the other thing they could do is actually taper. And I think this is what the market's wondering. Is this going to force the Fed to start tapering? Because the tapering is what is causing this sort of bloated balance sheet because the Fed is putting $120 billion of cash into the system every single month. And it is simultaneously withdrawing $120 billion in bonds, $80 billion in treasuries, and about $40 billion in mortgage-backed securities. And so that simultaneous effect is what's causing this issue in the reverse repo market. And so they could start to taper those purchases. The problem there is that comes with a threat to credibility in the sense that they just told us a couple weeks ago they're going to be on this schedule of QE through year end. So it would be challenging for them to reverse course this quickly. So I just don't know that they're going to pursue that rate out of the gate. They could also actively sell front end holdings. It's a little bit of a surprise to people, but they don't actually purchase a ton of 10 to 30 year bonds. Most of the stuff that they buy is sort of 4.5 years and in. And if they chose to, they could just sell some of their front end holdings and that would put upward pressure on interest rates. The last two things they could do is they could reinstitute that exemption that probably caused some of this at the beginning. But that has its own downsides because it primarily only affects the biggest banks. And the last thing they could do is increase the daily limit. They increased it from 30 billion to 80 billion back in March, and that's proven to not be enough. They could raise it again. They could sort of say like either there is no ceiling or it's 150 billion a day or whatever that number looks like in order to encourage people to keep coming to them and this. So they have tools. I don't know that this is a huge deal to them.
So we're seeing the flood of cash put downward pressure on the front of the curve. It seems like we've kind of getting a little bit more range bound on the 10-year, the longer end of the curve. We've kind of been in the 1.5 to 1.7 range here for the better part of the last 3 or 4 months. We're starting to see all these headlines about inflation, and the Fed keeps saying it's transitory. We're measuring these inflation rates off a very depressed base from 12 months ago. You think about where we were 12 months ago, still kind of largely locked into our homes, where if you were with me a night ago at the Mavericks game, there was 15,000 people and no mask and close confined areas, only seats that were open where the TV cameras would be on right behind the bench. So that was about it. So what are you seeing all this kind of translate? It's a mixed bag here. What's your crystal ball here, kind of go forward basis for, maybe talk around inflation and talk about kind of the interest rates for the remainder of this year, kind of going into 22?
Yeah, so I'll tackle inflation first. That as much as I wish I was in the camp of inflation is going to take off and it would make for a really cool story, I'm firmly in the camp that this is transitory, that we will see inflation spike. We're already seeing it happen. I believe that it's real, but I don't think it's going to persist forever. I think this past reading on Friday is a reflection of just measuring off of such a sharp contraction from a year ago. And that as we sort of work our way through the stimulus money and enhanced unemployment rolling off and people trying to find jobs, that things are going to cool off substantially by the end of this year. I do think it's going to be a pretty hot run for a while, maybe like 6 months. But that this time next year, we will not be concerned that inflation is running away from us. So I'm in that camp that I think basically what we've done is pull forward consumption, and we're seeing that in prices. But it'll settle down. It's not going to rise into perpetuity. I know that all our clients are commercial real estate folks, and they're like, yeah, but lumber, or I can't get contracts. All of that is true, but commercial real estate is a leverage game, and we are benefiting dramatically more so than the rest of the country because so much of our business revolves around debt, and debt is at 0%. It's so cheap to borrow money. And so we're able to afford to pay more for lumber because of that. If interest rates went to 5% tonight, all these projects would stop immediately. And I think that the Fed knows that. And the Fed knows if we had to, we could hike interest rates overnight and squash all of this. And so they will err on the side of caution and allow the economy to run hot because they learned after the financial crisis, it is challenging to create sustained 2% inflation right now. And I don't know that anybody actually knows why that is. Technology, globalization, aging demographics, all that stuff is kind of thrown around. But even if we don't even bother trying to figure out why, I think we can acknowledge that something has changed structurally. And all the measures that the Fed is doing today are the same measures they were doing post-financial crisis. Nothing's new. They already ran through 0% interest rates for 8 years and $4.5 trillion in quantitative easing. This has all been done before, and we couldn't get inflation. I don't know why this time will be different. So my crystal ball for inflation is, yes, it's going to spike. It'll feel hot for a while. Sit tight. We'll do a podcast a year from now, and we won't be worried about rampant inflation at that time.
What about the long end of the curve? Where are you seeing that going?
I think it's got a lid on it. I know everybody thought that the 10-year treasuries run up to 2% or north. I'm just not seeing it. I think everything that is priced in, the reason the 10-year ramped to 162, and that's a really key level for your listeners, is 162 is a very key level in the 10-year treasury. It's either the ceiling or the floor, depending on which side. And that it's not a coincidence that for the last couple of months, it's been gravitating around that number. That prices in almost perfect recovery, right? A perfect rollout of vaccinations, a perfect reopening of the economy, tons of stimulus. It's like everything goes right for the 10-year to get to 162. All it takes is a blip here or there to see it come back down. So I think that we'll probably be range bound. I don't think it should be below 1%. I also don't think it should be above 2%. And the further we go along, the further we get into this recovery, the more we're going to realize that we're going to be restrained by the global recovery, which is going to be well behind the United States. Global negative yielding debt will be a leash on our own debt because every time ours ticks higher, it looks more attractive relative to the alternative. And I think that this reopening is going to be very uneven and it's going to be very disjointed. And we're going to have a lot of crazy strong months and then some weird months where things just seem like they tanked. But it's just because we have such a mismatch between employers and employees and trying to put those people back together, reconnect all those people. I wrote in this week's newsletter that 37% of the workforce is not at the company that they were at in February 2020, which is just mind-blowing to me. And so there's going to be that sort of disconnect as we try to come out of this, get people back into the right jobs. And it's just going to take a while. We still have 8 million Americans. We got to get back to work. That's not going to happen overnight.
My question is, again, JP, what do you do if a lot of people don't understand a little bit about interest rates and how you know so much? So again, tell me what Pensford does.
So Pensford is an interest rate advisory firm. We primarily help clients think about ways to manage their interest rate risk. Typically, that involves interest rate caps on multifamily purchases. A lot of times the lenders, whether it's agency or debt funds, will require caps to be purchased. That's probably our highest volume business. We also help negotiate interest rate swaps for clients. So if they're closing on a loan with a bank, we come in and just help them negotiate that, just like a mortgage broker would help negotiate the terms of the financing. And then lastly, we do a lot of defeasances as well. So if someone is selling a property or thinking about selling a property, we can run some defeasance analysis for them and then help them with the defeasance closing.
So the reason why I asked that question is because I want to make sure I understand a little bit about, we talked a little bit about what's going on right now, what's going on, has gone on in the past, is really your business and what you're seeing out there. We talked a little bit about short-term rates, and we talked a little bit about the 10-year Treasury. But in the last, say, 3 or 4 months, you guys have done a lot of these interest rate caps, but have they been for bridge loans, or have they been through, say, the Freddie Mac floater loan? Give people an idea of where borrowers are borrowing money these days.
Yeah, good question. So we just had our busiest month ever in May. Thanks in large part to you guys. So we appreciate working with you. Last year, which is a little challenging for me to say, last year was our best year ever, which feels awkward given everything that was going on. Last year was exclusively agency, almost exclusively Freddie. I would say 95% of our volume was agency transactions, whether it's caps or defeasance, stuff like that. This year, it has been almost no agencies, and it's been almost all sort of what I would refer to as debt funds with required caps. It's just flip-flopped entirely. The COVID reserves, I think, basically took the agencies out of the business, and everybody started pivoting to the next lender that would give them aggressive terms without any sort of reserves to that extent. Although we are starting to see, I think maybe Freddie or Fannie just announced recently that they're getting rid of the COVID reserves. So we're starting to get more and more calls and emails about agency stuff. So maybe the second half of the year picks up. But for now, it is all debt funds.
Michael, talk a little bit about, SPI in your group. Are you guys doing bridge funds? Are you doing Freddie Mac loans? Doing a little bit of each? Tell me a little bit about what you're seeing out there.
Yeah, we've done 3 deals this year. We did an assumption, a bank loan, and then we just did a debt fund. And I wanted to shoot myself through that process and bought a rate cap through JP last Friday. And then here we are, we're buying 2 deals. One's going to be Freddie floater, they're back, and then to be determined on the other. We're still trying to pick that lender today, tomorrow, kind of going through it. And Freddie's starting to get back pretty aggressive for their more favored sponsors. I would say, Paul, I think they've kind of realized they were doing a bunch of business towards the second half of the year for a bunch of less experienced or less favored sponsors, and they're really kind of pulled back as we saw, and then they basically did 0 volume or next to 0 volume in the first half of this year, and now they're trying to ramp back up, realizing that they have a cap they got to go out and hit, and they're not going to hit it if they don't make any loans. So that's what I think we're kind of seeing in the marketplace, and they got pretty aggressive on the floating rate stuff. So I think if you're a preferred sponsor, you're going to get preferred pricing right now from Freddie, and it's going to be Freddie's to lose really. And the debt fund, I mean, it was great and the execution worked out, but it's kind of a lot of hidden cost, Paul, with legal and all this other crap they make you do that costs a lot of money, and you spend your own legal on top of that to comply with their legal stuff. And it was a little bit more of a challenging transaction. So I think we'd much rather go simple personally, but it got the job done for sure.
Yeah, bridge loans can be very expensive. And remember, bridge loans are just a temporary transaction. They usually are good for 3 years. They're usually an adjustable rate. They usually get 2 1-year extensions, but there usually is kind of a hammer on year 4 and 5. They don't want you to go that much farther. They want you to buy an additional hedge or come back to Pensford and buy an additional 1-year interest rate cap on the deal. So it can be expensive in doing a bridge loan versus a Freddie loan. But as I was talking to JP a little bit before this our podcast, is that I'm concerned that these bridge loans are going as rapidly as they have been, that it feels a little bit like the subprime market back 12, 15 years ago, where Fannie and Freddie were around, but they wanted to find a lot more business by offering subprime underwriting. So, Mike, what's your take a little bit on what's going on?
You're probably close to that. We're the sucker that did a bridge loan at 56% leverage or something. So I was shooting myself in the foot on the end of that, as we had 8 lawyers talking to each other, on some calls. But I think they're certainly pushing the envelope, and that's what's in part driving pricing. And as we talked about in kind of the Sunbelt markets, you're seeing a bunch of institutional capital and foreign capital that historically haven't played in a lot of these Sunbelt markets coming in. That's really driving down cap rates. And as we talked about, we're seeing 8%, maybe even more rental rate growth in real time. And if that is transitory, that's one thing. Whether that is sustainable for any material amount of time, you want to see pricing go up. That's going to make pricing go up on these investment sales deals. The money's out there and cheap. And as JP was kind of talking about, the alternative is zero. So they really want to get the money out into these assets, because all the banks are just flush with $120 billion of extra cash every single month. They got to go put it out. And that's really driving down the pricing on a lot of these loans. So it's really kind of the absolute golden age to be an apartment borrower, apartment owner right now. It's unbelievable. JP, I know I asked you this 100 different times, but if I had a 3-year or 5-year horizon, you float every time over fix it right now? Is that kind of your personal crystal ball?
3 years, definitely. 5 years, probably. 5 years starts to get into that scenario where you probably have to run the analysis. What would a prepayment penalty look like if you went fixed, things like that. 3 years and in, I'm definitely floating, because I'm expecting to be at zero or close to zero for the full term. And I would probably end up concluding the same for the 5-year.
What's a black swan event that would make interest rates go up versus a black swan event that made interest rates like the pandemic go down?
Probably has to be Fed inspired. If the Fed does something like a misstep or some sort of version of a taper tantrum, even though the market's prepared for that, so that won't be the black swan this time around. The Fed is so artificially making up the market that I think any sort of distortion will come from a misstep by the Fed. I don't think data right now can have that kind of effect. I think it would be the Fed does something wrong, and that sends market spiraling.
That sounds good. JP, if people want to get more information about what you do, again, there's the horse whisperer, there's the dog whisperer, and JP is the interest rate whisperer. If someone wanted to get more information about what you do to be closer to the interest rates, what's the best way for them to get in contact with you?
Yeah, just go onto our website, pensford.com. Check us out. We've got all of our contact buttons there, and love to engage in conversation.
That's great. Michael, any final thoughts or revelations?
No, I appreciate JP coming back on. It's always good to get a nice big bear hug and tell me my floating portfolio is the right move. So hopefully you're right.
Yeah, fingers crossed.
You're wrong. It's gonna be a bad day for this guy, yeah. But hopefully you're right. Seems to be right. I don't seems to be so many unnatural forces keeping the rates down for the foreseeable future that I think that's probably the right move, is to maintain the flexibility and take the lower pay rate, and over a 3 or 5 year time horizon, I don't see how you go wrong.
Yep.
Sounds great. All right, JP Conklin with Pensford. Always a pleasure. Thanks for being on the Old Capital Podcast. Michael Becker, the voice of reason. Thanks for being on the podcast. I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.